Does tax season stress you out? Do you ever really know how much you're actually paying in taxes, or do you just cross your fingers and hope for the biggest refund? Would you believe me if I told you that maximizing your deductions and your tax refund could actually be costing you more money? If you answered yes to any of those, then stick around, because in this video I'm going to be explaining as simply as possible how taxes work, along with just a couple of easy examples. And then I will debunk some common tax myths that are out there that cost taxpayers thousands of dollars. Hi guys, my name is Zachary Schleck, your personal finance coach. If you're new to the channel, my main goal is to help you win with money by gaining control of your personal finances. And like it or not, taxes are a necessary evil of personal finances. Alright, let's jump right into it. To first get the most basic misconception out of the way, no, your full income is not taxed, and no, it's not all taxed at the given tax bracket that it falls into. Throughout this video, I'll be using an example couple who makes $100,000 income, because I'm an engineer and I like examples with easy numbers. So, this couple's $100,000 income is not all taxed at 22% for $22,000. See what I mean? The two main reasons why are there are a ton of tax breaks out there to help you reduce your taxes, and the US uses what's called a marginal tax rate, not a flat tax. So, looking at that first reason, there are hundreds of types of tax breaks out there, and they can be broken down into three main categories. There's above the line deductions, there's itemized deductions or a standard deduction, and there are tax credits. Let's dive into how these tax breaks actually play into figuring out your taxes. First, you start with your gross or total income. Then you subtract any above the line deductions that you can. The most common above the line deductions are things like retirement plan contributions, student loan interest payments, and HSA or MSA contributions, and there are plenty of others beyond this list. And this gives you your AGI, or adjusted gross income. And your AGI is important because it is used to determine your eligibility for certain itemized deductions and tax credits. Next, you subtract either the standard deduction or itemized deductions. You can only choose one or the other to deduct, so you want to choose the bigger of the two for your situation. Some common itemized deductions are mortgage interest, charitable donations, and unreimbursed medical expenses. And again, this list could go on and on. But instead of going through the extra work of documenting and filing for all the itemized deductions you're eligible for, you can choose to just take the standard deduction. On the screen now, you can see what the standard deduction is for 2019, based on whether you were filing as a single, a married couple, or as a head of household. You can see that these practically doubled since 2017, so with as high as they are now, it will make sense for most people just to take this standard deduction rather than itemizing. After you choose if you're taking the standard deduction or itemizing, subtracting this from your AGI gives you your total taxable income. This is the income that is actually used to figure out your taxes. This is done by taking this income over to the tax brackets to determine what is called your tax liability. So now, let's take a look at tax brackets to see how they work. These are the tax brackets for 2019. Like the standard deduction, these are broken down into three options depending on your filing status. Remember, just to emphasize one more time, these dollar amounts refer to your taxable income, not your gross income. So as I'm explaining this part, anytime I mention income, I really mean taxable income. The big misunderstanding about tax brackets is that your income is taxed at the highest bracket it falls into. This type of taxation is called a flat tax, which means that a $100,000 income would all be taxed at 22% for $22,000. But these tax brackets actually use what are called marginal tax rates. And the way they work is that different portions of your income are taxed at different rates. So there is a 10% tax on all of your income up to $19,400, and all of your income above $19,400 is in the 12% tax bracket. So a 12% tax rate is applied to the portion of your income between $19,400 and $78,950. But every dollar below $19,400 is still just taxed at 10%. Once your income is greater than $78,950, that portion of your income is taxed at 22%. But the 10% and 12% tax rates still apply to those lower portions of your income. Now, coming back to our total taxes owed calculation, you can see how this total taxable income is used in the tax brackets to give you your tax liability. But there is still one type of tax break that you can use to reduce your final tax bill even further, and that is tax credits. These are the tax credits available for 2019. There are eligibility requirements for each of these, but if you find that you are eligible to claim any of these tax credits, then you would directly subtract that dollar amount from your tax liability to give you your total taxes owed. Now, let's look at two simple examples to help break this down a little bit. First, we'll look at deductions versus credits and how much each of them save you in taxes. Then, we'll move over to the tax brackets and see how to actually use those to get your tax liability. Now this part does get a little bit math heavy, but make sure you stick with me through this part because these examples will help me explain the tax myth that is costing you thousands of dollars. So first, let's look at how much deductions versus credits actually save you in taxes. Let's say our example couple put 15% of their income into a traditional retirement account such as a 401k, which is an above the line deduction. 15% of $100,000 is $15,000, so this will reduce their taxable income from $100,000 to $85,000. This whole range falls in the 22% tax bracket, so if you take 22% of $15,000, you can see that putting $15,000 into retirement saved this couple $3,300 in actual taxes owed. But a tax credit lowers your taxes owed dollar for dollar, so if your final taxes owed is $5,000 and you qualify for a $2,000 tax credit, your taxes owed drops from $5,000 to $3,000. For the second example, I'll show you how to use the tax brackets to find your tax liability from your total taxable income. We will again use our $100,000 gross income couple, and we'll use the most basic example possible where they have no above the line deductions or tax credits and they just take the standard deduction. So, starting with their gross income of $100,000 and subtracting $0 since they don't have any above the line deductions, their AGI will still be $100,000. The standard deduction for a married couple is $24,400, so subtracting that from $100,000 gives them a total taxable income of $75,600. Taking that taxable income over to the tax bracket, you can see that they started in the 22% tax bracket making $100,000, but just taking this one guaranteed standard deduction already dropped them to the 12% tax bracket. So the taxes owed on $75,600 would be 12% of their income above $19,400. So 12% of $75,600 minus $19,400, which is $6,744, plus 10% of their income in the lower bracket. So 10% of $19,400, which is $1,940. Adding these together gives them a tax liability of $8,684, which, if you divide that by their gross income of $100,000, gives them an effective tax rate of only 8.7%. Wow, so we went from thinking that a 22% tax rate applied to this couple making a $100,000 income to getting what is essentially a guaranteed maximum effective tax rate of 8.7%. And in reality, it will probably be even quite a bit lower than that since we didn't look at any above the line deductions or tax credits. Now, let's use all of that awesome knowledge that you just gained and debunk 3 tax myths that are out there. The first myth is that you should try to avoid increasing your income into the next tax bracket so that you're not subject to a higher tax rate. Now that you understand how marginal tax rates work, I'm sure that this myth seems pretty silly to you. So go ahead and take that raise or bonus or pick up some extra hours without worry of seeing a sudden spike in your tax bill. Now the second myth is that you want to maximize your tax refund. Now obviously if you're asking that question now as you're filing taxes from the previous tax year, then yes, you should be trying to maximize your tax refund since that's your money. But otherwise, no! You need to stop treating your tax refund as an annual bonus from the government. All a refund means is that you overpaid in taxes throughout the entire previous year, and you are treating the government as an automatic savings account, which the government is the least qualified institution to be used for that. 1, they don't pay any interest, and 2, you have zero access to your money until you file taxes, and then you have to wait forever to get your money back. If you know that you're expecting a tax refund next year, do yourself a favor and fill out a new W-4 form, which will decrease the amount of taxes that are taken out of your paycheck by the amount that you specify. The better question though, and the third myth that is out there that could be costing you thousands of dollars, is do you really want to maximize every tax deduction to lower your taxable income? And the surprising answer is no, you don't want to, because there's some deductions out there where you simply spend too much and save too little in taxes. With the earlier example of the couple putting $15,000 into retirement, which saved them $3,300 in tax savings, that's a good deduction to take because they're paying themselves first and getting a tax break for it. But let's look at 2 deductions that are out there that actually cost you more money if you choose to maximize them. The first one is student loan interest. Now, it might seem silly to think about maximizing your student loan interest, but that's really what you're doing if you choose to just pay the minimum payments on your loan each month. Let's say you paid $1,500 in student loan interest last year. If you fall in the 12% tax bracket, you would take 12% of $1,500 to give you a tax savings of $180. But you're still giving that $1,500 away to the loan servicer. So discounting this tax savings means that you're still spending $1,320 out of pocket. Let's say you make additional principal payments throughout the year, which means you will pay less interest to the loan servicer. If you only pay $900 in student loan interest, you only save $108 on taxes instead of $180, but you are only spending $792 out of pocket, which is $528 less than $1,320. And on top of that, you will have less debt from paying off your loans faster. The second deduction that people use the tax write-off as an excuse for while they pay more in interest is mortgages. The same math applies to mortgage interest as student loan interest, just in much bigger numbers. But there is a major caveat to the tax savings on mortgage interest, and that is that mortgage interest is an itemized deduction. So these quote-unquote tax savings don't even matter if you're just taking the standard deduction, which the majority of you watching probably are. So don't buy into these myths that it's okay to keep this debt around because it at least helps you with your taxes. Instead, work on paying off these loans faster so that you can simultaneously keep more money in your pocket and decrease your debt. I hope this video helped give you a better understanding of how taxes work. If you've ever bought into any of these tax myths, let me know which ones and why in the comments down below. And just a friendly reminder that I'm not a CPA or tax professional. I'm just an engineer who's passionate about personal finance, and I want to know what's going on with my money. If you want to see more content made to help you win with money, make sure you check out some of my other videos, where I go over all types of topics related to personal finances. Thanks for watching, guys, and I'll see you on the next episode.